Thank you very much. I am John Lipsky. I have two titles here at SAIS. I'm associated with the Kissinger Center and the Foreign Policy Institute. And it is my good fortune to be able to welcome to SAIS today Deanna Farrell, who you'll hear about in just a second. But first I want to say Dean Nasser is traveling today and regrets not being able to welcome Deanna here himself, but asked me to express publicly his admiration for Deanna, his appreciation that she's here, and his regret that I get all the fun by getting to introduce her, and then we'll have a conversation. Now, Deanna is here for a discussion on big data insights to the U.S. economy. And she is particularly well suited for this very interesting topic. You will have heard lots of talk about big data and the uses of big data and the potential uses of big data, but usually that discussion is very much up in the air. What exactly does that mean? What exactly can we find out from big data and how? Deanna is, I think, exceptionally well qualified to tell us about the big data and the U.S. economy. She is the founding president and chief executive officer of the JPMorgan Chase Institute. And that institute, which she will describe later as to what it does and how it relates to JPMorgan Chase, the corporation, the bank, the institute aims to help decision makers appreciate the scale and interconnectedness of the global economic system, and to use better facts, timely data, and thoughtful analysis to make smarter decisions to advance global prosperity. An interesting as well as noble goal. Now, previously, Deanna was the global head of the McKinsey Center for Government, and that group provided research, proprietary data, and other tools to support government leaders focused on improving performance. In addition, she was a leader of McKinsey's global public sector practice and a member of their partner review committee. So she was, I'm sure everyone was very nice to her, at any rate. But before that, she's also served in public office. She served in the White House as the Deputy Director of the National Economic Council and the Deputy Assistant to the President on Economic Policy from 2009 to 2011. And in that role, she also coordinated stakeholder engagements on the passage of Dodd-Frank Act, of which you once again heard so much from our new president. And she also served as a member of the President's Auto Recovery Task Force. So she's been very much in the front lines of some of the most important applied public policy actions of the Obama administration. But prior to her service there, she was previously the head of the McKinsey Global Institute, which you should have all heard of. Under her leadership, the Institute published extensively on a myriad of macroeconomic topics. Now, in addition, it's not Diana, it's Deanna. Deanna grew up in Colombia, and despite that resume that sounds very, very U.S. focused, actually has lived abroad, a fluent Spanish speaker, and a very deep knowledge of the international economy. Well, for these and many reasons, it's really a pleasure for me to be able to welcome Deanna here and for this conversation. So she has a presentation. She's going to come up here and make a presentation, including using some graphics. And then we will hold a conversation on that, and then we will open that to Q&A with all of you. So as you all know, in today's increasingly digital world, use of data has become increasingly important. And I, for one, was stunned to find yesterday reading in the press that Amazon has now become the largest retailer of apparel in the United States. And I'm thinking, I hardly knew they were in the business. So it suggests that there's an awful lot going on that leaves data traces that we might not know about. So I think the kind of work that Deanna and her colleagues are doing offers some possibilities of gaining some real insight into what's going on in the world and thinking about what we can do about improving things if we can better measure what's going on. So without further ado, let me welcome Deanna Farrell to the podium. Thank you.
Great. Thank you all for joining us. I'm a little cold, so bear with me with my jacket. But yes, John, thank you for that very nice introduction. And let me just start off by describing a little bit about what this JPMorgan Chase Institute, that's a mouthful, JPMorgan Chase Institute is all about. If you think about, and just link it to the question of big data and how the Institute is using it. If you think about what JPMorgan Chase is at some level, it's a balance sheet, a $2.4 trillion balance sheet with daily interactions that are tracked on a daily, on a monthly basis across all sectors of the economy. So in the case of Chase, it's consumers, many of you who may be Chase customers, not just demand deposit accounts, debit cards, credit cards, loans, et cetera. It's sort of monthly tallies of what's happening and changes in stocks over time. It's access to credit bureau data to understand the balance sheet view of the picture, all coupled with a lot of demographic information. And very importantly, all able to be integrated through connecting kind of customer IDs in different ways. Now, if that's the window that we have, the question is, could we carefully de-identify these data, strip them of all personal information, and use them as a lens to understand the economy better? That is the promise of what the Institute is trying to do. It's yet another think tank. It's got a public good orientation, as many of the neighbors you have here. But the real differentiator is access to JPMorgan Chase's daily activity, transactional level data, real activity, depersonalized, de-identified to develop a lens on the world. And with that, we do hope to put out public research, engage in policy discussions that will help people understand the world well. John, you mentioned that I worked at the White House at the National Economic Council at the peak of the crisis, right as we were going into 2009, and was painfully aware of how inadequate some of the information we had on which to make policy was, because it wasn't sufficiently high frequency, it wasn't sufficiently real time, it wasn't sufficiently granular enough to help us try to navigate. And here's the promise, a whole new data set brought to bear on the important question of what's really happening in the economy. So I talked about one of the important things that our data bring, aside from just the pulse on what's going on, is an integrated view. I don't know if you can see on the left here. If you think about all these products I mentioned and all the view that we have, we can translate those transactions and activity, daily activity, into data assets that map to what many of you studying here would understand as economic concepts: income, consumption, liabilities, assets, and understand that as a whole system at the individual level, integrated at the individual level. The only thing that comes close to doing this, say in the case of consumers, is the Survey of Consumer Finance that the Fed puts out. They do it every 3 years. It's under 5,000 households on a good year. And it's not longitudinal. It's not the same households over time. We're tracking on an integrated view millions of American families where we see this integrated view month by month in a longitudinal basis and can ask all kinds of questions. We're also doing this, as I showed in the previous chart. We've started primarily with the 50% of US households that Chase has a window on, but we're building the data assets also in the small business sector, ultimately in the corporate sector, and we are moving to the wholesale side, which is the JPMorgan side of the house. But I'm going to focus most of my discussion today on the consumer, the American families, which is where we've spent the most time building our assets. I have collected 5 levels of insight that I think are interesting. Because I want to make sure we get to the Q&A, I'm only going to talk about the top 3. But if in your questions you want to come back to the other 2, I can certainly do that. The 3 areas I'm going to talk about is first the economic and financial well-being of American families. And I think we are deriving some very powerful insights that are not particularly well understood with the data that are available, and we'll talk about those. The second one is many of you have followed all the buzz about the gig economy and the online platform economy. The data we have available on the development of that sector is very weak, not least because the census funding for independent worker survey was eliminated several years ago, and that would be the only place you might see some of this. We were able to home in on that and develop some pretty important understanding of what's happening there. I'll share that with you. And the third one is an index we've created to understand what's happening across 15 metropolitan cities in what we define as local consumer commerce. So those are the 3 I'll talk about. We've also done some very interesting work, I think, on the small business sector and on the impact of some of the Federal Reserve policy, quantitative easing strategies on consumption, which was ultimately the way the Fed was trying to pass stimulus at the time when I was in the White House. We can turn to those if there's any interest in that. So let's start with the economic and financial well-being of households. I mentioned the window we develop is we can look at all these transactions and in effect estimate income and consumption from that. And the first and most powerful observation we came to is that most Americans face very high levels of income and consumption volatility. It's not something that gets reported very frequently. For those of you who have seen any work on poor U.S. households, lowest income households, this is a topic of conversation. People know that low-income families get in a lot of trouble because of liquidity issues. We find that all Americans have this issue, very high levels of income and consumption volatility. What you see plotted here, again, individual lines, are green is income, blue is expenses, and these are 6 million observations across the whole country, where you see that on any given month, a household relative to a previous month could see a swing of as 25% in their take-home pay or in their expenses. Not particularly equipped to deal with that, as I'll come to, but that's a reality. Now, if you look at the left, you'll see this mapped across income, and our point is, while people have talked about this in the low-income world a lot, we see this level of volatility for both income and expenses true for all income quintiles. And if you look at it by age, you see that, again, almost all age groups are exposed to this. Younger age families will tend to have slightly higher volatility. Older families will tend to have, on average, less volatility, but you see that very wide dispersion in old age, meaning some have much less volatility, others actually have quite a considerable amount. And the drop in income volatility in particular is the fact that old families tend to move to either Social Security payments or annuity type of payments that are very constant in nature. That is not the experience for most Americans as a whole. Now, why is this important? It's important because it suggests a level of vulnerability for households. It's a stress test for households, if you like. To what extent are people having to face an unexpected increase in income or drop in income or increase in expense? And very troubling is to learn that these don't co-vary. So if you thought that a drop in income in a given month would translate into a drop in expenses in that given month, you might not worry about this so much, or vice versa. The reality is that we see these shocks in income and expense move independent of one another. What does that mean? From a stress test for a household, it means that you could simultaneously have in a given month a drop in income at the same time that you have an unexpected expense, healthcare, auto repair, a tax payment that was unanticipated. Most households are not prepared to deal with that kind of volatility. Many of you will have seen the Fed survey that put out that most families don't have the ability to withstand $400 of unexpected expense. Well, if we map out what we see in terms of the volatility I showed you by income quintile and by age, what you see here, I've circled this $2,400 number. If you're a mid-income household in your mid-age, 35 to 44, you would need to have $2,400 to withstand the volatility that is typical of people in that category. Most of you know we don't have that, and as I said, the Fed has shown very adequately that we don't. So if we were to apply a stress test on households, households are under a lot of vulnerability financially, and we've been able to document this even for everyday volatility. Now, if we think about extraordinary volatility, now go out 2 standard deviations for any given category, the problem gets substantially worse. We find examples across all these large sample sizes of what I would characterize as extraordinary payments. So it's got to be at least $400, at least 1% of your income, 2 standard deviations away in that category of spend. How often are you likely to experience that kind of extraordinary shock to your finances? Well, we find that 4 out of 10 families will experience at least one extraordinary payment in the course of any given year. That could be healthcare, that's a pretty high incidence. It could be auto repair, slightly low incidence, but still pretty high, or a tax payment, which is pretty extraordinary. And these are very high numbers, $1,500 type of expenses once you're talking about these extraordinary numbers. As I said before, paying more attention to this issue as a reality of American families is very important, and it links a little bit to the political atmosphere we see today. For us economists who have been tracking the economy, certainly since the low point of 2008, 2009, it's perplexing to hear the narrative about the economy that suggests that somehow we have a very weak economy that's not doing well. We have record low unemployment rates. We have wages that have just started rising. The economy is actually doing well. Why do people not feel that it's doing well? Because they see this kind of volatility in their everyday lives, and they value stability over growth. And this is what big data insight can really bring to bear. This is one example. I'm going to skip over this because it's complicated and I want to get through the next one. Okay, so online platform economy. We got interested in this story because the narrative that was taking hold was gig economy is the labor force of the future, and this is why people are experiencing volatility. We said, is that really true? Is that really true? Is this what's really going on? And so it was our income volatility lens that brought us into this picture. And we were able to identify a very large sample, again, big data at work, of 260 families who are receiving income from platforms. So remember, this isn't people who get on and order an Uber. These are people who are working for Uber. So this is the labor economy part of the so-called gig economy. And we defined it in a very particular way. So we said, look, this is not gigs as in plumbers and musicians. They've been part of the gig economy, so to speak, for a long time. This is this new phenomenon of online platform economies where you have to connect workers and sellers directly on an online platform. You need to allow people to work when they want to work, not when their employer says they want to work. It's a piecemeal type of arrangement. You get paid for one ride, one rental, one good or service, as opposed to some kind of retainer or salary. And the payments are intermediated by this online platform. So our definition, but we think a sound one, to say what is new and different about this gig economy. By that definition, we identified 260,000 earners, and we tried to say what's really going on and how representative is this of the economy as a whole. I'm going to make one important distinction, which turns out to matter when you look at the data closely, between labor platforms and capital platforms. Labor platforms being the Uber, Lyfts, Walk a Dog, Instacarts, where you're performing a service in exchange for money. The other being capital platforms, think Airbnb, Etsy, where you're either renting a good or selling a product. And those turn out to be an important distinction. But our sample was from across both of these. The first observation is, how big is this really if we map it to the underlying economy? And what we find is that it's important, it's sizable. It's not as big as the narrative would take hold. So we find that on any given month, 1% of adults are participating in platforms of one sort or another. Important, meaningful, it's a big economy, but hardly the future of work, as some people would have it. Because of the nature of participation, which is that it's sporadic, people come in and out, people don't tend to earn income on these platforms every single month. Over the course of study that we saw, which is the last 3.5 years, we see 4% of adults have participated at some point or another. Any given month, it's 1%. Cumulatively, it's 4%. Again, important, but hardly the future of work. What's probably more interesting and more important is the phenomenal growth rates associated with it. So in this same time period, we've seen a 47-fold increase in the number of people who participate on these platforms. Now, that's important. And from a policy point of view, our view is it's not that we need to worry about it taking over the market or labor markets. This is the time before good and bad things get solidified to create the infrastructure to make sure that this gets done right, if it's going to continue growing at this pace. Interestingly, and not always particularly well known, is that as rapid as this growth continues to be, the growth rates actually peaked in 2014. So we still see these participation in these platforms growing pretty significantly, but it's been declining. And some of you will have read articles about kind of discontent in the workforce of some of these platforms, some real issues as people wake up to the realities of other costs associated with not having benefits or wear and tear on cars or on apartments or otherwise. And so you see still very high growth rates, but certainly not in the peak of what we saw 2.5 years ago. This is true if you look at participation, which is what you see on the left, and it's true if you look at earnings on these platforms. So even as the volumes go up, the earnings are going down. The growth rate in earnings is going down as those markets become much more competitive. And you see here the important distinction between labor and capital, in the sense that the labor platforms are decelerating much faster than the capital platforms, even though they saw a much higher growth rate to begin with. We were also able to map the demographic characteristics of those who participate in these platforms, and you see a lot of variation across the country. These charts are hard to look at, but on the left, you see a number of cities, and the participation across cities varies dramatically. So a city like San Francisco has about 5% of adults in any given month participating. A city like Houston will have half of that, under 2.5% of adults participate there. Very different stories, both based on when these platforms started in these cities, but also the regulatory structure and otherwise that allows that to permit. If we cut this by income, there was a narrative that only low-income people participate in these platforms, just patently not true. Look at participation is actually pretty constant across all quintiles. It tends to be that lower-income quintiles participate more frequently in labor platforms, and higher-income quintiles participate more actively in capital platforms, but you see participation across the board. One of the important questions we answered was, how reliant are the people who participate on these platforms on the platform as their source of income? So are people really leaving traditional jobs to join these economies? And by and large, we find that's not true. It's supplemental income. Most people have traditional primary jobs. This is supplemental income to those jobs. And so what you see here by age on the far right is the reliance. What share of total income is coming from these platforms versus other more traditional sources of income? And I think to our surprise, while we know that young people participate more frequently, middle-aged people are more reliant on these platforms. And you see their ratio of total income coming from these platforms gets into the 25-30%, whereas for younger people, they're much more active, but it's a much smaller share of their total income. These are examples of ways in which we can bring this discussion to bear on the policy questions that have been pretty active, Senator Warner, others, around how and if we should establish a different category of work other than employer contractor, whether we should worry about different dynamics in the labor market. We hope that this data helps inform that. That's the second insight of the day. Third one, I want to bring your attention to another way in which we are not fully understanding what's happening in our country. If you follow the personal consumption expenditures, I mean, let's start with something you all know. 70% of US GDP is personal consumption. So what happens to personal consumption matters a lot to how we understand our economy. And if you follow kind of the aggregate data, what you learn is that personal consumption has been growing at a pretty interesting clip. And at some level, for an economy of this size and maturity, we shouldn't have any reason for concern. Well, we developed something we call the local consumer commerce, and we say, okay, but how does this translate into commercial activity in cities on the ground? And it's a different story. So this is measured by every debit and credit card swipe we see across 15 metropolitan cities. In our view, this is kind of everyday spend. It doesn't include things that you would finance separately, like autos. It doesn't include things that you would buy online. This is just what you buy when you go out to DuPont Circle and buy your lunch and get your nails done and get your hair done and go to the yoga, and think of every debit and credit card swipe across this huge customer base in 15 cities, and you see a pretty disturbing picture. As far back as 2014, you had relatively healthy growth rates between 3% and 5% on any given month, but we've had a pretty significant deceleration in growth rates throughout this whole period, and in the last few months, actually declines in this measure of local consumer commerce. Now, I mentioned before, if you go back to the personal consumption expenditure, that's been chugging along at 3-4%. Our measure, local consumer commerce, has been decelerating. You say, what's going on? What is this? And one of the big culprits, very important to how we think, again, about the health of an economy and a local economy, is the distinction between online sales and brick and mortar type of sales. And so the relative growth rates is all the growth in personal consumption is really coming in the form of online sales. These are growing in the teens. Not so when you look at traditional retail. The overall traditional retail numbers I showed you, 3%, it's all being, in fact, shoved to online sales. For many of us, this is a great thing. It's very convenient. I get on Amazon, you mentioned Amazon all the time, but it does come at a very significant cost to local consumer commerce and what's happening to local merchants and what's happening on the ground. Once again, helping explain, I would argue, the dichotomy between how people feel about the economy and the reality of the economy. The reality of the economy is personal consumption is doing great. But if you're a small merchant in a city, you don't see that kind of playing through, and you don't see it in the communities, creating vibrancy in those communities. And that's an issue we really want to bring light to. We can observe this not just in aggregate across the 15 cities, but also, city by city. And we've grouped them here in terms of large cities, medium-sized cities, small cities. Small cities have shown to be a little more resilient. They have seen the deceleration, but not to the same extent than the large and mid-sized cities you'll see listed here. We're also able to try to understand this with some of these demographic lenses we bring to the picture. And so if you cut this by age, you say what age groups are really driving the growth or the deceleration. And we find that young people, 25 to 30-year-olds, actually sustaining the growth. That's not where the deceleration is coming from. It's primarily older people, notably 55-year-olds and above, who are decelerating, are dragging down growth. That's one lens. And then the second lens I show you now is by product type. What are the categories of spend that are really shifting away from growth, at least in this local commerce view? And we find that restaurants, durables that relate to kind of experiences sustain growth. Those have actually been the little engines of consumption growth. Less so with durables, where we've really seen a drag. And for a long time, you'll see here the light blue fuel, gas prices dropping was actually a reduction in local consumer commerce. That's a slightly different dynamic, but it's played out very significantly throughout this whole period. I think this is really important. We're spending a lot of times with mayors trying to help them understand what's happening in their cities. And we can do this at the zip code level, which is a really powerful way to understand what is and isn't happening in cities. So those are the three insights I'm going to share. And as you can see, I threw a lot of very interesting data at you, but at the very high level, my objective is to get you excited about the power of big data, in this case, for the public good, for public policy, invite you to come to our website, read our reports. There's a lot more there that I didn't even share, and a lot more to come, certainly as we continue to build our data assets and our perspectives on what's happening, not just in the US with the Chase platform, but eventually more globally as we turn to some of the wholesale JPMorgan data. So with that, I'm going to pause there and hopefully start a discussion with all of you.
Great, thanks, Anna. That was terrific. For those whose eyesight
I know, I'm
has
sorry.
trouble resolving those little numbers, is it okay if we post this on the website?
Yes, absolutely, and all of it is even in more depth on our website. So please go ahead and post that.
And we should get into it later. I'll leave it to questions. Small businesses, household impact on household behavior of monetary policy changes.
Exactly.
Those are the other two topics, and there are interesting conclusions. Feel free to ask in the Q&A. Well, that was fascinating, and I suspect there's so many things we could talk about. I'm going to start off with one sort of clarifying question, and that is, okay, certainly this isn't all that JPMorgan Chase is doing with its data. Where does the Institute fit in, and what are the things that a big bank like JPMorgan Chase, that is the source of the data, what kind of things are they doing for themselves?
Yeah, great question. So certainly not all that JPMorgan Chase, or for that matter, large companies are doing with data. If you think about it, the Institute is a very small group, and we are taking advantage of a lot of what the bank has already had in place. We've only been in existence for 2 years, so clearly a lot went into this beforehand. But some of the major applications that the bank is undertaking with big data, I think, come in sort of 3 buckets. One is consumer insights. So just as we are trying to map to what's happening in the economy, you can imagine the opportunities to use these data to better understand customers and serve them better. You will all have experience, whether you're on iTunes or you're on Amazon, the ways in which the choices you make allow algorithms to learn your likes and dislikes and suggest other things that you might like or dislike. And this is true whether you're picking a movie on Netflix or whether you're picking a piece of music. You can imagine the product development applications of that. So there's a whole range of how do we serve our customers better and target products to them that are more suited to their desires and needs. There's a lot of variation on that, and that goes product by product. There are all kinds of things that could be done on that. There's another aspect of this, which is risk, really understanding risk by mining big data, different sorts, and recognizing that some of the initial underwriting and some of the reassessment of risk was very unsophisticated, and learning through these big data analyses, you can develop a much more sophisticated understanding of risk for the bank, for clients themselves, and customers themselves. And so that's another very large application for it. And there's a lot of, in kind of a broader third category, there's a lot of market information that the firm uses to understand kind of developments in the world at large that affect the business. So unlike our work, which is really about how do these data inform what's happening in the world so that we can help policymakers understand the world better, you could ask that same question of how do the activities that we see help us understand our positioning, entering a market or exiting a market, deciding to pursue a given transaction or not pursue it. Those are, I would say, are sort of 3 kind of big categories that are being used. And the platforms are huge. I mean, if you consider just something as trivial relative to the bank as our local consumer commerce, That today is over 20 billion transactions that are getting estimated every single month, right? The volumes are really very large.
Yeah, it's amazing. I should say, well, first of all, I assume implicit in there is that the kind of analysis the bank is devoting to its own purposes is really quite sophisticated and quite extensive.
I would think so, and I would say that, you know, when we were building this institute, hard to kind of make the case of why does the world need yet another think tank? It's a good question, especially when JPMorgan Chase already spends nearly $1 billion on research every year, whether it's buy side, sell side, macro, otherwise. And the answer is, you know, it's really because these platforms, first of all, these transactions are taking place anyway. So if somebody were trying to build the data infrastructure to collect these kinds of observed preferences across the economy, it would be very expensive to do. I can't imagine a think tank that could raise the kind of money to do that if there wasn't kind of an underlying commercial purpose. But so too with all the capabilities, the infrastructure for collecting the administrative data, the technology platforms for processing it. And what allows us to do what we do is that the bank has it as a matter of their business undertaking these very sophisticated approaches to this.
This is great. As an aside, some of you may know I was chief economist at JPMorgan Chase from 2000 to 2005, and we instituted an effort for not public purposes, but for the firm's own purposes, to try to see if we could mine the data that we had then. And I just tell you, in 17 years later, things have changed, obviously, very dramatically. What we found at that time, without going into the gory details, we couldn't tell much.
Yeah, that's right.
Part of it was data was hard to get, hard to utilize. Secondly, the use of the relative importance of this kind of data, i.e. credit card data, et cetera, was much smaller.
Sure.
And it was changing rapidly. So you were never, what we were trying to do was to say, looking at the same data, could we anticipate what the conventional measures, economic data that is used conventionally, produced by the government, could we anticipate the direction by using that data? And found 15, 17 years ago, the answer was no, actually we couldn't.
Yeah, no, and I would add a couple of things to you said. One, which you point out correctly, is the degree of financial transactions, the share of financial transactions that were electronic, even as recently as 15 years ago, was actually quite small. Most people didn't have credit cards. You certainly wouldn't buy many, many things with debit and credit cards that you do today. I mean, I just put 97 cents of something on a credit card, and nobody said anything about it. That was certainly not true, 15 years ago, where minimum purchases were $25, $50 kind of thing. So that to start with, but I would argue that the capabilities that are allowing us to create these data assets didn't exist as recently as 5 or 7 years ago. So I'm talking about the kind of machine learning techniques, the artificial intelligence approaches that allow you to say, okay, these transaction strings have these pieces of information. How do I take that, again, for very different purposes, administrative or otherwise, and translate it to something where I can have a high level of confidence? I'm talking about an economic concept, i.e. income, spending, transfers. Those, we're hiring some of the, I think, top doc students out of econ programs and data science programs to help us develop those algorithms and those rules-based systems that you can then apply real kind of machine learning to. 7 years ago, I mean, I would argue we're still in the nascent stages of that, but there's a lot of really good capability that has been developed. Just wasn't there 7 years ago. You would have been at a loss to understand how to take, trillions of data points and apply algorithms to understand what you were looking at. So on both counts, I think you were before your time when you tried to do this.
Very kind. A comment and then two related questions. So we've seen articles recently in the press that seemed to be at a turning point in terms of the role of online commerce, and your data suggests that may well be the case. In other words, we're still in the midst of some very large behavioral, let's call them behavioral changes that affect the shape of the economy. So the two questions that are growing out of that, one, is there a lot more that you feel like you will be able to learn from the existing data available? And second, is there a lot more you feel you could learn if you had access to other data or additional data, and if so, what would that be?
Yeah. So the answer to both is yes, hugely. I mean, as I said, I think we're on the very early stages of any of this. And we're, I think, laboriously and carefully going through a process of building out that whole sort of lens that I described: income, expenditure, liabilities, assets, and I would argue we've just started. I mean, there's certain things I didn't mention, but questions that are very vexing for traditional analysis. We had a precipitous decline in gas prices over 2014, 2015, 45% drop in gas prices, typical retail prices in the US. And as you can imagine, the Fed and many other economists were desperate to sort of say, what was the impact of that gas price decline on consumption? Very difficult question to answer with aggregate data when gas spend is 5% of total spend, and you have such heterogeneity of spending that each household is going to react very differently. How do you get your handle on that? Our data were very, very, very well suited to that, and we could do that. That's just one of 50 questions I could pose to say the existing data don't do a good job. We could do synthesized control experiments to understand and isolate the impacts of any given thing. So a lot more we can do, and I could give many examples along those lines. But I think to your second point, even more that we could do if we start coupling data. So already we are combining our data, for example, with credit bureau data to get a better picture of the balance sheet. We are ingesting a lot of census data to ensure that we're doing appropriate benchmarking and mapping to the underlying demographics of the cities we look at, because the Chase platform may not be as representative, but we can create very representative samples if we understand the underlying census. We've talked to other private sector companies. I think it's still way too early, but think Amazon, think ADP, think people where if we could get these data and connect them in interesting ways, we could do. So I think this is really a very early beginning to what 10 years from now will be a key part of our sort of data and economic understanding infrastructure.
Yeah, sounds great. Well, let me follow this up with two areas, puzzling areas of our economy, and see what you think you've been able to find, or whether you think you will be able to find out. One, of course, is the employment market. As we've seen, we have a very low unemployment rate, but we have very low participation. We've had long-term declines in participation rates that has been unanticipated, and we've had post-crisis rebuilding of employment that hasn't gone exactly the way we would have anticipated. What insights have you been looking at that area? What insights have you been able to find? What insights do you think are going to be possible to find about that kind of employment behavior?
Well, we have been looking at some of it, and I would argue the online platform economy work was one example. We were trying to identify a critical micro market, labor market, i.e. these online platforms, and sort of inform that picture in a way that's important as we try to develop what policy would you even want to consider. You need to understand what you're looking at. We will do a very good job of understanding how labor income, think payroll, et cetera, fits into the overall story. And I think that's where the sweet spot is. And, as an example, when I was describing the online platform economy work, even if we hadn't cut short the census data on independent workers, even if we had that, mapping kind of labor outcomes to consumption outcomes, labor outcomes to other forms of well-being, that's really hard to do with any of the data that exists out there. I think we'll have a sweet spot. We probably do less well, and we will do less well, we probably won't do at all, with understanding kind of what may be a much more important part of the labor market, which is, the skills evolution, the mismatch, et cetera, which actually requires, I think, a very different lens. But I hope that we'll still be an important part of the overall story.
Yeah, exactly. In other words, the market seems to be throwing out very clear signals about what skills you should acquire if you want to succeed, and it doesn't appear that that message is getting through as clearly as you would think.
No, and as much as I hold enormous enthusiasm for the long-term prospects of what we're doing as we build these longitudinal databases, so far our data assets pretty much start in 2012. So for the last 4 years, we have a very clear window. I think to understand long-term labor market impacts, you need like the 20. So check back in 20, 30 years, we might have more to say. At that point, we'll have linked with, education data and with other data, and we'll probably have much more to say.
Right. My second question along this line, one of the big puzzles, really, when you boil it down, why has growth been disappointing in this economy and in the advanced economies in general? And I've spoken on this many times. It's been the shortfall of business investment more than anything else that has been the problem. And one of the big surprises is in a situation, excluding the energy sector, which has had its own reasons for boom and bust, more recently, things have been, especially in the U.S., very favorable for business investment. Profit margins relatively high, the liquidity very high, declining energy prices. For everybody outside the energy sector, that's been a big boost. Interest rates historically low. Why hasn't there been a bigger response in business investment? Is that something you've been trying to look at, or?
Well, let me say, first of all, I completely agree with you that is one of the biggest and most important puzzles, this sort of secular reduction in the investment intensity of GDP for one, but also relative to opportunities and I think we will inform it in some ways, but as with the labor market, probably not so well in other ways. The ways in which we can inform it is just as I described the examples of having this integrated view of families' financial condition, we can develop an integrated view of businesses' financial condition. And not in the way that 401ks do or kind of the gap accounting does, but in the real sort of day-to-day of how businesses operate, which we think is a different lens. We're learning is a different lens, as I mentioned with the small business work we've done. And we also have the ability to take the loan data and understand how that kind of plays through. And loans are often very closely linked to investment, and we can map that out. I think the issue is that to get so that's part of the equation. I think we'll answer many questions related to that. The questions around investment and its link to returns and productivity and otherwise, which I would argue are the maybe more important question that we would seek if we wanted to address the economic angle. That's going to be harder because we will not understand the full picture to really understand returns or productivity within the company. And so that's a bit of a disappointment because I do think that's one of the most important questions, and we will only answer part of that puzzle.
Now, let's look to, as you've mentioned it in passing, when you were back in government trying to get things done under real pressure from events, the data that you wanted, the information you really felt you needed wasn't there. Has that the kind of progress you've described also affected the ability of public officials to design policies? And if so, let's put this delicately, is there any evidence that that kind of insight is actually being applied at either local, state, or federal level?
Well,
or are things lagging?
I think the only place where I could claim I've seen real progress in this regard, as I mentioned, is at the city level. I think that the ability to, take something like the the personal consumption expenditure, or the MRTS, the Merchant Retail Trade Survey. That's done at a national level, and for cities to translate that into what it means for them, they usually have to wait for the full year, and then it's kind of deduced from the national level data because the sample sizes aren't big enough at the city level. That's a disaster. I mean, most mayors and most city development planners just aren't being able to, they don't have those kind of tools. And I think this is helping this and other efforts, not just us, there's real promise where people are starting to do things differently as a result of that. I would argue that even some of the work we've done so far, early days, has helped elucidate some policy decisions. So this gas price report that I mentioned, I hope was part of what at the time, meaning at the end of 2015, helped the central bank realize that it was too early to move on rates, because what we'd seen is people were actually spending all that savings from the gas prices, and the hope that there would be more wind in the sails of the economy from those savings was not going to materialize. So the economy needed to be a little more robust. That would be an example where I think the microdata helped a policy decision maker. I think it's really, I could probably come up with two other examples if you're all interested. So I think that we see glimmers of it, but it's early days. And I think the hardest thing where I see the most promise, especially after these data get offered over a longer period of time, is if you think about the challenges we had at on the economic team during the crisis. When we developed the Recovery Act, that was the largest stimulus package ever designed. It was $800 billion. We were developing that with an understanding of what was happening in the economy that got revised 3 times. Since that time, we had to make the decision and put in place the recovery provisions. It turned out the economy was much, much worse than we realized. Much, much worse. And 3 revisions later, we were like, if we had known that then, we would have pushed harder to break through that $1 trillion barrier, which politically people thought was inconceivable. And maybe it would have been. I mean, people today like to second guess our decision not to push for even more. It was pretty hard to push for $800 billion when nothing like that had ever happened. The idea of breaking a psychological barrier like $1 trillion, I don't know. But it certainly would have helped if we had data that was more attuned to what was really happening on the ground. I think the power of these data is these aren't going to be revised. I mean, these are transactions that took place, and we've tabulated them at the time. They weren't estimates and models. So I think those are the promises that we can look forward to in the future. And certainly a huge part of my motivation is I hope if we ever face a crisis like that again, there will be more sources of much more fine-tuned and high-frequency, real-time data that can be made available to people trying to make decisions.
I don't want to be accused of leading the witness, but is it reasonable to conclude, first of all, that there's real promise for the design of public policy virtually at all levels of government through better use of data? And does that also mean that that public sources, public institutions, should be trying to do more than they are today to develop these sources, either directly through the work of Department of Commerce, BEA, what have you, or indirectly through funding research through NSF, et cetera?
Yes, so you can lead me on that one, only
Okay.
one. Absolutely, there's no question that we're just starting. I'm very concerned about the loss of a constituency in Congress and in the public around public data. As excited as I am about these private sector data working their way into our understanding, I don't for a minute pretend that they're going to substitute the important data infrastructure that is part of our country's and our government's data sources. But in this last budget, if you saw what they're doing to decimate all collection of data, it's really appalling. I think it's a terrible long-term disservice to our country. I think we need that. We need foundations to step in. I like to think of what we're doing at JPMorgan Chase as a proof of concept of what many more private sector companies can and I would argue should be doing, because we do sit on these huge repositories of understanding about what's happening in the economy, and we should never be as unprepared as we all were collectively during the crisis. These data exist. We need to find ways of mining them. So I think we do have a big promise. And there are a lot of interesting things happening in this space. So I'm pretty optimistic.
That's great. Now, final question from me, and then we'll open it to our audience. Your work is centered on the U.S. JPMorgan Chase is a global institution. There are other big global institutions, financial institutions, and others. What's your sense? Is much going on? Is equivalent activity going on elsewhere? Is it behind us? Is it in some areas actually ahead of us? Where does this stand?
Well, let me start with us. It's true that all the work I presented and the work we've done today is US-based. Why? Because we've started with the Chase platform. As you know, that's a US retail platform, but we have no intention of stopping there. I mean, we're just, this is going to be a multi-year investment in building data assets, and we've already started kind of mining the JPMorgan wholesale trade data, and that will be a very global database. So I think we're moving in that direction. Although I think it's important to note that as global as JPMorgan Chase is, and it operates in over 60 countries, it serves most central banks and most, it's not as global a picture as you would ideally want to have for a true understanding of operations all over the world. We have, infrastructures that exist to develop a more global picture, whether it's the BIS or the IMF or other places that have been collecting these data. Those need a real lifting. Those are often, as with all the limitations of survey-based data, self-reported by countries and under slightly different, if not hugely different definitions. They get brought into central areas. So there's a lot more that can and should be done, but I think that's going to be a much bigger lift, even in our work, because our view will be only partial of the operations of JPMorgan. Yeah,
although editorial comment, my expectation is the more we can see the results of work like yours,
the more impetus.
You're going to have folks elsewhere saying, exactly. Why aren't we getting that?
Exactly.
Why, right?
That's right.
I think it could and should happen. Your turn. Let's have questions. As always, please state your name and your affiliation for the benefit of Diana. And let's start with this young lady out here.
Hi, thank you. My name is Erin Dumbacher. I'm a second-year student here at SAIS. I was interested particularly in your first section, your conclusion about Americans' valuation of stability over growth. And certainly you showed compelling statistics about income and expense volatility. Are there other indicators, other data sets that also contribute to that conclusion? I think it has real political implications. I'd be curious what else you're looking at.
So the two things that I would say, I don't think they're the only two things, but two I know well is Pew studies attitudinals, and the Pew survey data have a question very framed like that. If you could choose between stability and growth, which you would choose, and overwhelming. But the other one, which I think is probably better because it's just much more thoughtfully done, is CFSI has done, I should remember the name of the survey. It's incredibly powerful, in-depth survey over time, working with families to really understand the whole picture. And they developed case studies of a large number of families and really kind of documented this probably in a way that unlike our work, which is just observations and deductions and correlations and whatnot, where they really have kind of causal and narrative stories around what's going on. So those are the two that I would point to. But I think there are others.
Great. Next, over here. And we'll come back.
My name is Dimitri. I'm looking for affiliation, actually, but thank you very much for your presentation. Very interesting. So I just have two questions. One of them is I'm interested in your with respect to gas prices, as far as your ability to like estimate price elasticities for consumers and maybe exchange rate elasticities for businesses, as far as if you're able to do that? And the other question is to go back to like the stimulus packages you talked about with the rebate checks they sent out. I'm wondering if you had this survey now, if you'd be able to look at what was done with those rebate checks as far as feasibility and legality of that whole thing. If the government sends out checks, what people do with those. Thank you.
Whoa, a lot packed in there. Let me take a couple of those. So questions of the MPCs, the marginal propensity to consume from new income. That's exactly what the gas price story tried to do, is to say we see at the individual household level a increase in income, disposable income, as a result of lower gas spend. How do we see play that out? And we've actually estimated that from the peak to trough, and then we estimated over the whole year of low gas prices, and we see very high marginal propensities to consume. And in the early, very deep drop, we estimated as high as 80% of that was spent. Afterwards, it was still a majority, but it was slightly lower than that. So I think that we are very, like, that is where I think our data are strongest, because we can isolate kind of impacts of everything else going on to the thing we're trying to observe. And I would say more recently, we've done this with the mortgage resets. So part of the monetary policy attempts to get more money into the economy was by lowering interest rates that would drive down adjustable rate mortgages, which did the same thing, pocket in the money of people, and then we could see how did they consume it and did they consume it. Just an interesting note that most people don't realize, the gas price decline that we saw peak to trough 14 to 15 was the equivalent of about $700 a month for families that, on average, which is basically the amount of the rebates. I mean, so it was that magnitude of stimulus. So just in terms of could we observe how the rebates played out? Yes, in some ways. We could tell that for those families who got the rebates, how did they spend it? Did they spend it? How, et cetera? That, to the extent that there was any fraudulent activity in how people got the rebates, et cetera, we wouldn't see that. All we would see is the rebate coming in.
So you could see the rebate, like in your data, you can say this person got a rebate and this person did not.
Sure.
Actually, I have to now ask a follow-up question, because household sector's net saver, business sector's net debtor. So low interest rates, primary effect is to lower the interest income of households. Secondary effect, lower mortgage costs of debtor households. Could you look at the net effect of this on households in general and on their spending?
It's so important, and ultimately, you really do want these second and third order general equilibrium effects to understand all of this. We did not. This was a very micro lens at the individual household level. I think the only thing I would say is that while the household sector is the net provider of savings, at the micro level, most households don't have any savings. So, drop in risk, the decline in interest rates, meaning that their savings aren't accumulating as fast, is much less impactful for most Americans, not for the economy as a whole, than a drop in either gas prices or mortgage costs.
Out here, this lady here, please. Right there. Yep. Thank you.
Thank you. My name is Astrid Jakob-Sipadua. I'm Minister for Food and Agriculture at the German Embassy. And as you know, ag is a sector where we're working with big data already for a long time, precision ag, so there are special problems with it. You have a lot of data, but a limited number of individuals who are delivering the data, so you have a lot of data protection problems. And in general, they say if you once put somewhere some data, it always leaves its trace. So there is then the data protection questions. So I would be interested if this is one problem in your area as well. The other thing is I'm very much interested in the rural urban division or divide, no? The gaps.
Yeah,
And
yeah.
would your data be able to help politicians to be more specific what is needed? And maybe a third one, we are now all in the times, that's more looking ahead, you know. But there are all the SDGs, fighting hunger, it's a problem in all countries. So obesity, nutrition, healthy nutrition. So do you think that these systems are able to capture which measures will be effective in the future? Because I think that is what we all want to monitor. We want to see we do some whatever kind of measures and what are their effects?
So third, I'll go backwards. Yes, I think the promise is huge, not necessarily our data assets, which are just a financial view, but anecdotes you'll hear that I think are incredibly promising. Google matched up with the CDC to start tracking searches of flu symptoms. And it became the basis for understanding where the flu was going and getting vaccines to those places sooner, for example, because people start searching for the symptoms a week and a half in advance of when they actually, are in full-fledged. And I think the promise of those kinds of examples of kind of mining data in these really interesting ways, and we're just at the early beginnings. But I'm sort of simultaneously optimistic, and you hear my enthusiasm. But I think many people who don't know this stuff that well underestimate how hard it is to do. So it's both incredibly promising, a lot that can be done with all sorts of data, but it's going to require a lot of investment, a lot of very smart people to figure out how to do this, and I think we're just a little piece of that. On the rural-urban divide, I agree with you, that's a really big issue. I think it is in this country, but not just in this country, in Germany, in France, as we await this vote, in the UK, this is really a common theme that's occurring. I think we will inform that a little bit, not as much as we could. Why? Because the Chase platform is primarily an urban platform. So we operate in 23 states, not 50. A very large share of our customers are actually in the cities. That's not to say we don't have anything, no view on the urban landscape, but I don't think we will have the best one. But I share your view that we need more of that kind of information. And we will try to inform that a little bit. I just know that we have some limitations on that. On the first question, which is the privacy and the data re-identification issues, huge deal. It's a huge deal for the bank, as you can imagine, because we are the largest bank in the country. We serve, I told you, we touch 50% of US households in one form or another, and protecting customers' data is one of the highest priorities for the bank, not just because there's a regulatory overlay for it, but there's a long-term customer relationship building overlay. And I would just say that the bank has invested an enormous amount in building that infrastructure and addressing it. Lots of things that are happening, especially the young people in this room are doing, that are undermining that. So every time you get on one of these apps and you give them all your information and you sign away all your rights, those are entryways that those apps could be, deleteriously used to attack the infrastructure. Very mindful of that, and we have enormous amount of attention that goes to worrying about those issues. And in our case, with the Institute data, we have set up what I like to think are kind of best practices on how to do that, both how the data come into our assets to begin with. So we will not build Institute assets with any personally identified data in them at all. They've been stripped of that before we get them. We have very strict protocols on who accesses data, under what conditions, and the surveillance that is used so that if anybody were ever trying to do anything with it other than the research purposes, and the people themselves. We vet our people pretty extensively, and that doesn't 100% guarantee the results, but it's part of the question. And I would say that I live in the world of understanding the risks and feeling like we have to work collectively as society to address them, but to pretend that trying to block this activity is the way to address it is really not the way to go. So, but it's really important, and I think our institute, and for that matter, the bank's success is going to rest on getting this right. So,
Thanks. Thanks. You're in front? Want to wait for the mic, please?
Mag Diamin at IFC, and a SAIS alum.
Good.
So there was an article a few weeks ago, I think it was in the Washington Post, that talked about the growing influence of for-profit consulting, providing policy advice. And it strikes me it was the advent of big data and the importance of that. Models like yours, where you're leveraging not only for-profit sides of the business, but also the data associated with the underlying business. I guess the question is, what role in the ecosystem does that leave for the traditional think tank that doesn't necessarily have the for-profit wing?
yeah, good question. And I for those of you who didn't see this, this was an article by Dan Dresner, who's a very thoughtful guy in his own right, where I think he points out a challenge that I would argue universities, think tanks, others have, which is, how do we ensure the best quality research that we can with the independence that you want research to be associated with. And I think he points out the evolution of private sector think tanks having more influence than they probably had before. But if you might be concerned about that, recognizing that even think tanks are subject to funding sources, et cetera, and that's kind of an ongoing evolution. So I like to think of this as a space that is evolving very rapidly, where I mentioned this about government data, where it's not really a substitution, but it's a different kind of rearrangement and different unique contributions that sectors will play. So one of the things that will be obvious as you observe what we've done so far and what we'll continue to do is we're always asking ourselves the question of, are we uniquely positioned to ask that question and answer that question? And if we're not, there should be others who can and do. And I think the answer to your question is, right now, many people who operate in the world of ideas are thinking, it's like kids in a soccer field. They all run to the ball that is like the most interesting, theme of the day. And I think what will happen is people will develop a clearer sense of where they can uniquely contribute. And that's certainly a discipline we try to bring to ourselves. So I imagine we'll see a lot of evolution in the space in a positive light, but I don't want to be Pollyannish about it. I think we citizens need to be very mindful about the disclosure of funding sources, the skepticism, the healthy skepticism about private sector ideas. I really, when we launched the Institute, I was very keen and determined to say, don't just take it at face value that this is going to be independent. Look at our methodologies. You'll see all our reports go into extensive detail about how we've done things so that they could be replicated. We have validators, including from academia and from others. And I think everyone should be held to those standards of, equivalent of peer reviews and criticism where it's warranted. But I think that the world of ideas is changing dramatically, and I think universities, traditional think tanks, private sector think tanks are all going to have to reaccommodate what and how they do it.
Yeah, that's great. In the back there, yeah.
My name is Daniel Moon. I'm a first-year student at SAIS. I think on a related note to the previous question, besides different levels of government, I think another area where we've seen big data applied is politics in its narrow sense. And I'm talking about how presidential campaigns are using aggregate information from social media to identify likely supporters and voters, how political consulting groups are using big data to predict voting behaviors of lawmakers. And I think I've been reading about how the State Department is also using some form of quantitative analysis to analyze voting behaviors of delegates at UN conventions and such. And that makes me wonder, what do you think could be the impact of the use of big data, or on a more general note, quantitative analysis in the realm of politics as we understand it today?
Whoa, that's a very good and very big question. I guess that I would add to your good question the dynamic of one thing is if you're out there trying to understand through big data what's happening. The other thing is if you're out there trying to influence what's happening with big data. And I think we have both dynamics going on. And I think that the kind of issues that Facebook is dealing right now as being a conduit of a lot of kind of self-perpetuating narratives, for example, that may or may not be grounded with any validation, or it's a brave new world, and I think that like so many things, we could put our head in the sand and say we don't like it and it has to go away, or we can say this is kind of the way the world is going. People are choosing to participate in these social media platforms. They are choosing to get their news this way. They are doing certain things, and we have to own it as a society. We need to understand what the parameters are and try to shape it as best we can. But I think it's just the beginning of what we're going to see. I think we've been, slowly planting the seeds of that kind of active participation in the political process, good and nefarious both. And I don't think it's going away anytime soon.
Yeah. If I could add, this is, I think, a commonplace observation, but it seems when I look at my own children and younger kids, their idea of what should be private and what is public is just way different than my idea. Their idea of maintain data privacy is just a whole different.
Got no bounds, yeah.
Yeah, no, exactly. Yeah, okay.
Hi, Tony Porter. I sit atop of a big data company, and I'm co-founder, partner of a federal technology incubator, and I'm a SAIS alum as well. Fascinating, absolutely fascinating. So many use cases. A couple questions for you. The first, it's kind of in the category of Wayne Gretzky. You're going to skate not where the puck is, but where it's going to. A lot of your user base, I'm assuming, I haven't read your 10K, and I don't bank at your institution, but I'm assuming a lot of your user base is migrating from brick and mortar over to a mobile platform for convenience and other reasons. There are a lot of benefits from a data collection perspective, and that's a geolocational component to it. It goes to activity and identity resolution. How do you anticipate that changing your model as the more data that you receive with the geolocational tag to it, the more insightful you can become, not only from a customer behavior perspective, a risk perspective, but the work that you're doing? That's the first question. And the second is, I was going to ask you about, if you're leaning to the public goods side, and you've got a lot of raw data that others could potentially use for the public good if you had an open API. But the answer to your question earlier, it sounds like you protect your data quite a bit. So the question that I was going to ask is succeeded by another question, which is, what do you consider to be PII? What's inside the realm of PII? So I'll have a better understanding of what you consider to be out of bounds when you strip something out when you're anonymizing individual records. Thank you.
Want to define PII for those who don't know? Personally
identified information.
Yeah.
So let me combine the two last questions because they're actually relevant. So, the precise definition of what is and isn't PII is like, volumes of legality. But in its simplest form, it's, name, social security, address, things that would allow you to take a transaction and link it back to an individual in a way that is identified to that person in the real world. And we do have very strict stripping of that data, but maybe more importantly, to address the confidentiality issues, even after having stripped that data, we never disclose any data, single data point. We aggregate things so that we'll do the analysis at the individual level, but in all the charts that I showed you, every data point is several data points, so there's actually no real person associated with any piece of data we ever publish. And I encourage anyone who's interested, we actually have listed out some of kind of our guidelines for how we do this. And we continue to revise it and review it because it's an ever-changing game, and we'll try to stay always on the front end of it. Having said that, we have developed certain data series that we think there's no risk of identification. And so, for example, I talked about the local consumer commerce index, where we are taking debit and credit card swipes, and we are then using the samples we have to map to the demographic characteristics of each city. So at the end of the day, like, the identification issues are like inconceivable. Like, you even if you wanted to do it, you would be impossible to do. And those data series, we not only publish ourselves and publish on them, meaning we do research where that's the foundation, we put them on our website. So they're out. If you go on our website right now and look under local consumer commerce, we have put out these monthly data. We do it by city. We do it by age, income, size of business, product of business, relationship from merchant to, and we are actively encouraging other researchers to use these data and do their own research on it. We're working with Carnegie Mellon, who have some really cool data visualization things that they're doing to figure out how much they could do and link it to other data assets that they've already created at the city level. So we are very excited about participating in a, if not real open data in the full sense of that, we're certainly never going to do that at the transactional level or something else, in ways that can be really helpful, not just to what we do, but to what others do. And that's pretty exciting, I think.
Great.
Oh, the first issue on online. So this question, there's no question that there's a behavioral shift that is occurring, and most of us probably haven't been to a retail branch in a long time because we're doing everything online. Having said that, there are all kinds of regulatory issues that play into this. So today, large banks can't bank you unless they have physical brick and mortar presence. So I mentioned our platform, Chase's platform, is only 23 states. We have very active brick and mortar plans to keep growing that. And I think the view of the bank, which I really don't speak to because I just run the Institute, is the retail branches, brick and mortar, are going to be a critical part of the whole picture for a long, long time. There's no sense in which it's kind of people want both. They don't want just one or the other. And that's kind of what I think most of the large banks are doing, certainly what Chase is doing. From our narrow Institute perspective, the more people go electronically, the better, because our data quality goes way up. So the trend is a good one as far as research on the economy is concerned.
Great. Well, we've come to the end of our time.
We have. That was
Yeah.
great. Thank you for all your thoughtful questions.
Well,
I really
thank you.
appreciate that.
Now you all know what I knew in advance, that this was going to be a real treat, as well as hugely informative, and that we are very lucky, first of all, that Deanna was able to spend this time with us today. Secondly, that she's undertaken this work. And it gives you a lot of, I think, confidence and enthusiasm that this not only is going to be taken forward, but taken forward in a way that's going to produce benefits for all.
Well, thank you, and thank you for having me. Really enjoyed our time together.
So.